Hellwig. When we were both younger, so which means almost 40 years ago, we had our first tenured position in the same department of economics at the University of Bonn, without directly overlapping. Then we both left to Switzerland, in his case to Basel, and then at some point we both returned to Bonn, separately of course, where Martin Hellwig in 2004 became director of the Max-Planck-Institut for research on collective goods. And he has also been chairman of the German Monopolies Commission. He has been on the advisory boards for the German Ministry of Economic Affairs, for the government, on exit strategies for crisis-induced participation of the German government in German banks. So a very fascinating challenge. So he has had a tremendous impact, not only in academia, but far beyond, including the media. So he's very visible in the German media scene. I remember one Spiegel interview a year ago with the concise title, "The Banking Sector Must Shrink." So we are now looking forward to this.
Well, I will not talk about the need for the banking sector to shrink, but I will actually talk about the subject that I put up. And actually the first time I wrote a note on this was in a policy context when I had realized that some of the participants in the debate, debate among officials about the implementation of the increase in capital requirements in the fall of 2011 and the subsequent systemic effects of that increase did not really understand what was going on. So at that time I wrote a 5-page note for the General Board of the European Systemic Risk Board saying that what they were doing was actually systemic. Much of what I have to say and actually comes from policy experience and comes from the attempt to relate what we're doing here, scientific or academic research, with the policy debate. I think it's important that we should take up that challenge. Yesterday I was already asking, what is macroprudential? I don't know. Now a lawyer will know, because he must know, and a judge must know, because it's a legal term. It's in the regulation establishing the European Systemic Risk Board. It's in the Capital Requirements Directive and Regulation. So if ever any of this gets into a court proceeding, you'll have lawyers deciding what it is. And I'm reasonably convinced the definitions they will give will be convenient for whatever objectives they have in mind, but will be dressed up as legal reasoning. I mentioned yesterday already that the origin of the term is somewhat mixed. There was a talk in 2000 by Andrew Crockett, then the director of the Bank for International Settlements, before an audience of supervisors saying, we shouldn't just be worried about individual banks, but we should be worried about the macro effects of individual banks all doing the same thing. After that talk, supposedly he was persona non grata at that conference. By now, it's very clear that it's not microprudential. Any microprudential supervisor will tell you that no macroprudential authority should meddle with what they're doing. What Spain did in the years after 2000, what we should have been doing in the years before 2007, What exactly was that? Systemic risk is also a well-established legal term. That's why we have the European Systemic Risk Board. This institution is supposed to analyze systemic risk and to provide warnings and recommendations to competent authorities, if necessary, asking the competent authorities why they didn't comply. Some of the literature, Adrian Brunnermeier, Acharya Engel, systemic risk is something that we can measure. And it's also something that we can tax. So we should have a tax on banks according to their systemic risk implications. Are we really so sure that we know what we mean? Some basic ideas. We should not leave the matter to lawyers and judges, but establish some conceptual framework for the matter before they get to it. We should not pick up every externality that we might think of. Welfarist economists like to pick up every externality without bothering to think whether the authorities will actually be in a position to deal with that. Important feature, we need to go beyond models. And much of this talk will actually be about the relation between models and policy discussion. And by models, I mean both the toy models that Phil Dybvig referred to yesterday and the calibrated macro models of which we heard one example this morning. We always must think in terms of how the models would fit into the political and the supervisory discourse. We also must think in terms of institutions, governance, and procedure, and appreciate that institutions are very ill-suited to deal with trade-offs. Phil was making the remark yesterday, we need to trade off lending by banks and safety of the financial system. If you give an administrative authority, a regulator, the task to deal with the trade-off, he'll choose whatever he wants and say that he's just on that side of the trade-off, unless we have more basic principles involved in this. I mentioned yesterday already that when we talk about macroprudential policy, it's not clear whether the objective is financial stability or macro stability. On the upswing, when you are worried about everything getting out of hand, the two objectives might actually call for the same actions. But when the economy is weak, well, right now, we have the problem that, in particular in Southern Europe, banks don't lend very much. SME lending is very reduced. This is the main theme of discussion at the ECB. If you look at the empirical work by Acharya and Steffen, they'll tell you weakness of lending is concentrated in weak banks. Weak banks take the money they get from the ECB and invest it either in their sovereigns or in the market. So, should we first deal with the weakness of banks, or should we first deal, or should we encourage these banks to do some lending, even though that might weaken them further? Underlying this, there is a deeper question. What do you do when your banking system is about to be bust? Do you use forbearance, like Alan Greenspan in 1990 changed monetary policy around so as to provide U.S. commercial banks, the big U.S. money center banks, which were on the verge of insolvency. It's not clear on which line of insolvency they actually were. to give them the chance to play the yield curve for 4 years and thereby recapitalize. Or play the game of the Japanese authorities that allowed their banks to not recognize problem loans, thereby dress up their balance sheets as if they were solvent, hoping to get out of this. They're still hoping to get out of it. The alternative, the Swedish recipe, jump in, clean the system up at the cost of a very sharp recession. The Swedish recession 92 to 94 was among the sharpest they had since the Great Depression. And afterwards, well, hope that afterwards you have some resurgence. These questions about the intertemporal trade-offs involved in how you deal with financial weakness at a time of economic weakness are completely unresolved, and I think we'd better do something more about them than we've done so far. Systemic risk. I was mentioning yesterday that here too we have lots of possible definitions. Risk from the financial system to the economy, that's what most politicians think about. This is why they think if banks are weak, nevertheless they have to lend. Risks to the financial system from the economy due to a macro shock. That's been a major cause of banking crises over the last century. And that's in fact the risk that I would have mostly thought about in this context. Or finally, risk to the financial system from problems at individual institutions and contagion. One of the interesting features about the past 50 years is that until the last 2 decades, most financial crises have been due to some macro shock, hitting banks that were similarly exposed. Over the past 20 years, we've seen a number of financial crises that involved significant contagion. Are we talking about different things? What are we talking about? Well, sometimes, okay, the examples of macro shocks, the S&Ls in the early 80s were insolvent because of a bad incidence of interest rate risk. They were sitting on long-term mortgages from the 60s at 6% fixed rate with 2 more decades to go, and short-term market rates were on the order of 10 to 15%. Sweden, a dramatic downturn in real estate, and the same for Japan. Thailand, an exchange rate shock. Now, an interesting feature about the Thai experience is that the allocation of macro risk gave rise to contagion. If international banks had been lending to Thai banks, after all, you want to export capital, and had tried to protect themselves against the exchange rate risk by writing all their contracts in dollars. So the Thai banks were indebted in terms of dollars. They were lending to Thai firms. Since they didn't want to bear the exchange rate risk, they lent to the Thai firms in terms of dollars. So all the risks were hedged. Came the devaluation of the baht. Thai firms, well, they were earning money in baht and were indebted in dollars and went into default. And the Thai banks were in trouble. And if it hadn't been for the international bailout, the bailout by international institutions, the international banks lending to Thai banks would have been in trouble. What we're seeing here is an example of a contagion effect that comes about because the different participants try to hedge macro risk through the forms of contracts they choose, and then they find that the macro risk comes back to them in the form of correlated counterparty credit risk. So let me give a brief overview over what we've seen in the crisis. We had the buildup of risk in terms of subprime lending and securitization, and I probably should add here in terms of lending to Greece, lending to Irish banks, and Irish banks lending to Irish real estate developers, and same thing for Spanish institutions. Then in August 27, you have the downgrades of all those AAA rated securities by several grades at once. And then you have a big surprise, because much of this stuff was not actually held by banks, but was held by shadow banks, except these are not hedge funds or so on, but are simply the special purpose vehicles of regulated banks that they use to escape capital requirements. Everybody knew that this had been going on, but people had not added up the numbers to realize that on the order of $1 trillion worth of securities was held in such institutions. Given that these institutions these special purpose vehicles had no equity, they were immediately bust, and the money market funding for them broke down. This is what Gorton refers to as the panic of 2007, except it wasn't really a funding problem, because most of these special purpose vehicles were taken back into the balance sheets of their parents. It was a capital problem. The parents didn't have enough equity to back this up once this had to be put on the balance sheet. And that then set off the deleveraging process that Ramakont and his co-author talked about yesterday, where, well, if you have insufficient equity, what do? You sell assets. That depresses asset prices. Under fair value accounting, that feeds into the balance sheets of other banks and puts pressure on them as well. It wasn't a panic, it was a very slow implosion. At some point in this process, people began to have doubts about the viability of Bear Stearns and Lehman Brothers, at which point you got a run on these institutions, which in one case was finished by Bear Stearns being taken over by JP Morgan Chase with a guarantee from the Fed. In the case of Lehman Brothers, that was ended by the insolvency. The insolvency had an immediate domino effect on a money market fund. That led to a run on not just this money market fund, but all others as well. That led to a breakdown of money markets all over. The banks scrambled for cash, and asset prices all over declined. This is a distinction I made yesterday in one of my comments, that there is a difference between fire sale externalities driven by a lack of equity and fire sale externalities driven by a lack of cash. So we have both liquidity narratives and solvency narratives for this entire story. I don't want to go into details, but of course both of them were right, and there were both solvency problems and liquidity problems. The interesting question about the entire episode is, why so much systemic risk? The base losses from subprime were probably not much larger than the base losses from Japan. For both numbers, I've seen numbers on the order of $500 billion. Of course, Japan was isolated, and subprime was interconnected. Was interconnected through contractual relations and through asset prices and fair value accounting. Why do we have so much of that? Well, fair value accounting is supposed to enhance market discipline. Everything is laid open right away. Individually, a disciplining device, collectively a source of contagion. Risk management with a bias towards dealing with measurable risks and towards getting risks off the balance sheets. The term risk-weighted assets has appeared a number of times. Encourages banks to hedge things. So you buy credit default insurance from AIG, and then that risk no longer appears in your risk model, i.e. you don't need to have equity for that risk. But you neglect the correlations and wonder when the counterparty credit risk hits back. I recommend that everybody should read the report that the Swiss bank UBS wrote in 2008. This was actually April 2008. Reports to UBS's shareholders about UBS's write-downs on subprime securities. Have we really had an improvement in risk allocation? Well, in the past, we had system crises arising from a common exposure to macro shocks. Right now, we have system crises arising from an exposure to macro shocks that has been hidden in hedge contracts. Is this an improvement? What does it mean for the analysis of system risk exposure? Can we assess system risk? Before we can even think about the matter, we need to develop some kind of alphabet or some kind of dictionary for the language in which we talk about it. And I've tried to provide a list, but I should add that when I provided such a list on previous occasions, say around 2000, the list was much shorter. And I have a suspicion that if I was to do the same list 10 years from now, the zoo of animals, or rather the set of animals in my zoo, would become even larger. So the standard concern, of course, is a domino. One institution fails, another institution that has claims on this institution has to take write-downs. The reserve primary money market fund had an 800 million exposure to Lehman Brothers, which it had to write down, and as a result of that, the value of their shares went from $1 to 97 cents. A more subtle form of interconnectedness involves contracts that you haven't concluded yet, but where you're sure that you will be able to conclude them. Lehman Brothers was a market maker in London. And many institutions expected that for risk management purposes, they would be able to rely on Lehman Brothers provided market making facilities for those derivatives. Once Lehman Brothers was gone, those were no longer available. And the British authorities actually say they couldn't even have managed to continue them because with integrated cash management in the company, there was no cash for even a temporary continuation. That's for anyone who expects to have an ability to use that facility for managing risks, that's a systemic effect. The money market fund investors running basically impose a surprise on the money market fund managers. They no longer have these funds available that they expect to be able to use. And in terms of orders of magnitude, in the case of reserve primary, within a week, 60 billion out of 62 billion had left. So we're talking really big numbers. The money market funds no longer provide money market lending. For an institution like Dexia or the German Hypo Real Estate that had used the money market to fund the excess coverage on their covered bond issue, that was a very bad surprise. So we need to think about the systemic importance of potential counterparties on whom everybody had counted, or on whom important players had counted, of those counterparties just disappearing, and therefore market opportunities disappearing. Information contagion. Lehman Brothers not being too big to fail implied that other investment banks might not be safe and contributed to their being run upon. Reserve primaries breaking the buck meant that other money market funds might not be safe and they were run upon. In the European context, in May 2010, a major argument for bailing out Greece was that if Greece was not bailed out, Spain, Italy, and Portugal would be in trouble. Now, anyone who knows about sunspot equilibria in runs games will tell you that sometimes information contagion might be hysteria contagion. That would be the diamond-diptych version of this. Or in the Morris-Shinn version, you might just have hypersensitivity to small pieces of information. Because, I mean, having uniqueness of equilibrium in Morris and Shinn does not preclude the possibility that in a certain part of the range of the fundamentals, a very small shift in the fundamental may lead to a dramatic shift in outcomes. One of the interesting features in terms of information contagion, if you look at the story about Lehman Brothers, the repo run was triggered from events in the stock market. Some stock market investors had looked into this more closely and had sold the stock of Lehman short and made public that the books of Lehman's were cooked or did not represent reality. And then the money market fund managers looked into this as well. Asset price contagion, we talked at length about those yesterday, so I will not say any more about that. Credit crunch contagion, defensive strategy of one institution leads to a reduction in lending, which forces borrowers to become defensive, which may impact the entire economy. In the case of Lehman's, we had some combination of all these mechanisms. I don't have the time to go through this again. So how do we do systems analysis? We're talking about a multiplicity of effects in a highly nonlinear system, which probably has multiple equilibria, which there is no transparency about other participants' positions. Think of the $1 trillion surprise about the exposure of SIVs, structured investment vehicles, to subprime. And moreover, the different participants are changing all the time, and the credit risks are endogenous. The first person buying a credit default swap from AIG faced zero counterparty risk. By the time AIG had a 500 billion exposure to highly correlated credit default swaps, counterparty risk was significant. Assessment of these counterparty risks depends on what the others are doing. Quantitative analysis. All the data series we have, if we do have them, are short. The set of phenomena that we're interested in is non-stationary. And hidden correlations play an important role and are changing all the time and are endogenous. In the early 90s, when I worked on interest rate risks, I talked with a banker about this, and he said, interest rate risk? We're not exposed to interest rate risk. We use asset and liability management for maturity matching. Not quite, but always. Using money markets, and later on the story was swaps. Suppose you have three banks, A, B, and C. Each bank has 1 billion euros in deposits and 1 billion euros in 40-year fixed-rate mortgages. In addition, Bank A makes a short-term loan X to Bank B a short-term loan X to Bank C, and Bank C a short-term loan to Bank A. If X is very large, each individual bank and each bank-specific bank examiner will think that the bank is almost perfectly maturity matched. The system as a whole transforms deposits into 40-year mortgages. Taking a system perspective is very different from taking a perspective at the individual institution. I modified the example to consider 480 institutions, where institution I would borrow at maturity I minus 1 month and lend at maturity I month. At any one institution, the maturity mismatch was 1 month. For the system, it was 40 years. Same argument. The system risk is hidden in the correlation of counterparty credit risks with the underlying. And all of that is neglected in the bank's individual risk assessments and in the regulation. Are the examples surreal? Think about the explosion of short positions that we've seen with the advance of repo borrowing and lending. Many bank balance sheets look like the balance sheets of those three banks, A, B, and C, that I've shown before. And it goes back and forth, and it's very difficult to assess what is system maturity transformation. Think about the transactions chain that was generated in the build-up of the subprime problem. You have the investor giving money to a money market fund. The money market fund giving money through asset-backed commercial paper to a special purpose vehicle, say, of Sächsische Landesbank, one of our German heroes in the crisis. The structured investment vehicle, special purpose vehicle, gives money, buys CDOs from a special purpose vehicle of an investment bank, which packages mezzanine securities into CDOs. So they get the mezzanine securities from another investment bank, which packages mortgages and securitizes them. That other investment bank provides the funding to the mortgage bank provides the funding to a mortgage borrower, and that's used to buy real estate. You transform effectively demand deposits, because those claims on money market funds were something like demand deposits, into real estate. That's enormous maturity transformation. And they had delusions that they were not involved in maturity transformation. There were also delusions about liquidity risks and delusions about credit risks, mostly due to a neglect of systems effect. So I've given the example of, well, there are examples about what they did with the SIVs. My favorite example is Gary Gorton suggesting that there was no maturity transformation involved because contracts in subprime lending were designed in such a way that they would have to be renegotiated after 2 years. So interest rates were fixed for 2 years, and after that they would be renegotiated. Well, that assumes that if you want to raise the rate after 2 years, there is no credit risk. And of course, the credit risk is correlated with the underlying. We had this experience before in the UK around 1990. Rate adjustment in response to high market rates of interest induced defaults and foreclosures. Of course, that went along with low collateral values and a systemic problem. The underlying problem is that the final asset is long-term, and the services you get from that final asset, namely the living comfort of the people who live in it, is fixed. So I want to discuss a little bit about methodology. All the animals in the zoo of contagion sort of are based on toy models. So for each of those I can write down a toy model, to use Phil's word from yesterday. But models are not theories. Models are building blocks that we can use to think about phenomena that we encounter. An important way to think about this, or an important feature in this context, is we've got to think about this as a general equilibrium problem. The flaw in Gorton's assertion this was not maturity transformation was that he looked at just one contract without considering the general equilibrium of the system that was involved. And we need to look at the entire system of transactions and positions in order to take account of the possible correlations. And the trouble with that is it's highly contingent. These patterns change from episode to episode. This is where I get back to the point that I made before. The crises of the early 80s and the crises of the late 80s and early 90s were crises of parallel exposures to macro shocks. The more recent crises were crises of hidden exposures to macro shocks because institutions had used contractual devices to hide the risks. But the underlying macro shocks and the underlying system risk exposure was the same. I come to this methodologically from competition policy. When you look at a merger case, you don't believe that you have a model that suits all markets. The first thing you do is you take the unstructured mass of material that you get from the various reports and try to figure out what is going on. And then you turn around to your shelf of competition models, of I/O models, and try to determine which models are relevant for thinking about what we are observing. Typically it's not one, but a combination of 4 or 5. And the main professional challenge lies in developing a routine for how to do this properly. I've always dreamed about giving a graduate course on the subject, and the problem was I would never get beyond saying, in such and such case I thought about the following, and in such and such case I thought about something else, which isn't exactly what you can communicate. But basically this issue, the interplay between trying out models and collecting and assessing data, going back and forth between them, trying to understand what's the story behind what we are observing, is important. Let me give an example about this. At one of the ESRB meetings, there was a presentation of what's the development of banks' profits. Oh, and yearly banks' profits over the past 3 or 4 years have been moderate. Nothing much to write home about, but not worrisome. Now, if you looked at the numbers, what you saw was actually for each of 3 or 4 years, sizable profits in quarters 1 through 3, and an even more sizable loss in the fourth quarter. So my reading of that was these guys waited until the end of the year in order to decide how much of a write-down can we take in order to have a black zero for the full year. And not that they actually had bad outcomes in the fourth quarter. The fourth quarter was when they made their accounts. So my question then was, how many more skeletons are there in their closets? The problem is when you see a set of numbers to come up and interpret what's the story behind them. And that's of course true for all the stories that I've been talking about so far. If you think about fire sale effects, what do those depend on? Financial robustness and capacities of potential purchasers. Lehman's problems, bubble problems, market illiquidity. Long-term capital management in 1998 was not a large institution, but it was deemed systemic. Why? Because in that particular situation, markets were nervous. There were many institutions with similar exposures as LTCM, and there was a fear that if LTCM was liquidated quickly, that could have a dramatic fire sale price impact. Would the fire sale price impact of an LTCM liquidation be uniform across all situations? Of course not. It was that particular contingent situation in which the problem arose. This is what makes me very skeptical about the scope for actually having descriptive models that we can calibrate in order to predict what will be systemic risk next year. I think we need to think about the story of what's going on all the time. Macroprudential analysis, I think the term macro should be prohibited, in that respect is not very useful because the term macro suggests a connection to the business cycle. But of course, when we talk about asset markets, both for the slow implosion following an equity squeeze and for the fast implosion following a liquidity squeeze, we're talking about completely different timescales. And we do not have any theory that would enable us to talk about different timescales in one model. Let me take a step back from this, and this will be the final part of what I have to say. To institutions. The decisions must be implemented by macroprudential authorities, by central banks, and by fiscal policy authorities. Who's going to be in charge of doing the analysis? If I look at the European Systemic Risk Board, I don't know what it's like in the US. It typically comes from either the central bankers or the macroprudential supervisors or some combination of the two. Do they understand about systems? I have some doubts about that. I've seen quite a number of presumed discussions of systemic risk that were basically just about individual institutions. Look about each individual institution and the system is safe. And something like my two artificial examples would not figure. This issue of trying to understand the story for the system is one that requires a different mode of thinking from any of these guys who will implement the decisions, which is why I think it would be very useful to have a body whose task is exactly that. The BIS and the IMF staff do a little bit of that, not enough. But this is what we have to make room for, and I think we as economists should provide some of the meat for how these analyses should occur. That can be separate from whoever is taking the decisions, because if you take the decisions, you must worry about how will they implement them. And of course, there, the distinction between microprudential and macroprudential is not very helpful, especially because the microprudential supervisors often overlook the macro dimension of what they're doing. Some of the systems implications of the encouragement of risk hedging are an example for that. They hardly ever think about what does it mean for the system if we encourage institution A to shift the risks elsewhere. A major example for that problem is insurance regulation. Much of the development of insurance regulation under the guise of what's called Solvency II will induce insurance regulators, insurance companies to reduce the maturities of their investments. So that means that the banking system may end up doing even more maturity transformation than they've done so far. If you think just about the insurance company, you forget about that. We need some kind of system story and some kind of institution whose task it is to address the system story. That's all I have to say.
Okay, questions,
When I try to take a message from your talk, I think you showed us that how complicated the issues are and how inadequate some of the attempts we are trying to launch to understand these issues are, and that we really don't understand very much. So when I ask myself why it is so difficult to understand and go through the examples you gave, lots of them had to do with time, for instance, like lacking coincidence of needs across different points in time, maturity transformation, or with interconnectedness, that people do not understand or ignore the complicated web of relations they are embedded in. And of course, perhaps these issues are so difficult to understand for us as economists because the concepts we have are not really adequate to capture this. So for instance, in economic theory, we treat time as just another dimension of the commodity space. Maybe this is wrong. Or we think about equilibria as centralized clearing of markets and do not think about the web. So perhaps it's not enough to do modeling after modeling, but as you said, we should perhaps have the courage to do more theorizing and invent new concepts that help us better to understand these issues. What do you think about that?
I partly agree, but I don't want this to become a nirvana project. I think that there are some things that we can do without addressing all the issues that you raise. I think, and I think that in that respect, some of the developments of macroeconomics have actually been unhelpful. namely putting standard macro analysis into an infinite horizon discrete time setting, or even continuous time setting, requires us to be very precise about all intertemporal linkages. And typically we then simplify by imposing stationarity. In the real world we don't have stationarity, and we don't even know what's the proper time scale in which to be thinking about these things. Once upon a time, one was talking about something like the short run, the medium run, and the long run, and one was very imprecise about what the relations between those were. I think if one is willing to accept that notion of impreciseness, one can actually make some progress. Now, the other element in what needs to be done, and this is part of what I was referring to when I was saying, what's the story? We need to go beyond the individual toy model that identifies a contagion effect or an externality, and find a routine for asking questions about what do we see in the system. And the common theme in the story I told was that at any time the system is subject to a certain number of macro shocks. Typical example would be interest rate shocks, business cycle, exchange rate shocks, real estate prices. And if you think about the real allocation, you know that these shocks matter. And you can ask the question, who's bearing those risks? When you see, as in the case of the old S&Ls having 40-year fixed rate mortgages, the answer is obvious. When you see something like the chain of transactions for subprime mortgages that I characterized, if you begin to ask the question, you will look at the entire chain of transactions and then ask the same question. So if one starts from the notion that the major risks to which the system is involved is exposed are likely to be risks from macro shocks, and you then ask who's bearing these under current contractual arrangements, that provides you with some information. The other thing that we need to do, and this is a slide over which that I skipped over, in terms of macroprudential policy, much of the macroprudential policy that we're thinking about, and Tobias Adrian's slide yesterday gave a very extensive list, was prudential ex ante. And we have done very little work so far on having circuit breakers ex post, mechanisms that would break contagion mechanisms when they arise. So there, again, if you start from the notion that there are some macro shocks that are there, if you have the given contractual system of contracts that allocates these risks somehow, if you think about the impact of a shock, where do we need circuit breakers? I think those are questions that we can analyze with conventional tools, provided we're satisfied not to be immediately writing down a comprehensive model of the entire economy, but to just be adding to our zoo of analyses on which we can draw to think about the current situation.
I think Martin Zummer had a very good point. And in a way, it's a kind of a nirvana project in the short run, but in the medium term, I think it's a challenge. And maybe there's some division of scientific labor, in the sense that that's the corner where mathematicians have a useful role to play. And I mean, just the one comment you pointed out, and completely agree, that implicit stationarity assumptions can be very, very off the mark. And actually, when Bernoulli published his law of large numbers, Leibniz wrote him a letter saying, complimenting him on the mathematics of the proof, but pointing out that he is doubtful, because Bernoulli had in mind application to the social science, to the economic science, that the implicit stationarity assumption really applies in many of the situations one would like to analyze. So, okay, further questions?
So you remarked about this time.
Can you speak up a bit?
Yeah, you talked about the different time scales involved in this phenomena. So liquidity typically evolves over short time scales, whereas solvency issues evolve over longer time scales. On the other hand, the tools available for policy are pretty much static. This time dimension is lacking. So there's the capital ratio, the liquidity ratio, but so in Basel III, they have introduced, for example, this net stable funding ratio, which is the first time you have some explicit accounting for the maturity mismatch and transformations and so on. Do you think this is an interesting direction, like explicitly embedding some dimension of time into the tools available for regulation?
I don't really know. Let me add to the complication. All of our models are based on the assumption of a centralized market system. Now, the role of money in the payment process, or more vaguely, the role of payment processes, is important because we do not have centralization. And we have no idea about the sort of how the timescale of payment processes interacts with timescales of asset markets and timescales for the real economy.
You mentioned this idea that old crises have been caused by the common exposure to a macro shock, and that new crises are basically in a similar way caused by hidden exposure to a macro shock. Now, this sounds as if we look at it from a system perspective. It's basically the old crisis and the new crisis are the same, and the only source of risk is this exposure to the macro shock. I remember from our discussions yesterday this keyword of manufactured risk, which was basically man-made and not just due to an exposure to a macro shock. So what do you think? I mean, what might be ways of manufacturing risk, and is this really irrelevant?
I've been wondering about this. One answer to this question, and this is now a specifically German answer. The downturn in fourth quarter of 2008 was the first time for a long time of a macro downturn caused by a financial downturn which didn't have at least a domestic macro background. So that would support your view, but of course there was a macro shock background in the US. Now you might say, wasn't this manufactured because of all this stuff in ninja lending based on subprime mortgages? I'm tempted to answer yes, except then I realize that we had similar problems in Ireland and Spain with traditional mortgage lending. We had similar problems in Japan and Sweden in '92 with traditional mortgage lending. So in that sense, the notion of boom and bust in real estate finance also, while it allows for an independent role of the financial sector in generating procyclicality, but it seems to be similar across instruments that have been used. And we need to understand more about the similarities.
Okay.
You mentioned that indeed the most recent crisis has occurred due to this sort of hidden risk.
So can you speak up a bit?
Sorry, the most recent crisis has occurred due to hidden risk, also with CDOs. And I was wondering to what extent hedging contributes to systemic risk, and whether the perceived risk-freeness of hedging actually is true, and how we should be hedging in the future. So sort of the role of hedging in systemic risk.
I think the answer would depend on the context. I mean, what concrete problems would I be thinking of?
For example, with the CDOs, people thought that they could.
Sorry,
with CDOs, people thought that they could hedge their risk, whereas actually there was still risk in the system. So do we are we misguided by thinking that by hedging we actually hedge a risk, whereas in fact the risk just lies somewhere else?
Okay, we should get rid of risk weights. Except if a bank takes a riskier than average position, whatever that may mean, they should be forced to use more equity. I mean, the name of the game about risk weighting is, every banker would tell you, and similarly the bank supervisors, banks that take more risks than normal must have bigger equity. The actual negotiation or the actual practice is banks that claim to be taking fewer risks because of all these hedge contracts and so on are allowed to get away with less equity. In terms of logic or mathematics, you would expect invariance to a sign change. If you multiply both sides of the equation by -1, you'd expect the outcome to be the same. But in terms of politics, it's a huge difference. It's claimed to be something designed to discourage excessive risk-taking. It's something designed to enable the possibility of getting away with very little equity for things where there is an enormous mismatch between actual risks and assessed risks. So, okay, this is now also an answer to Rama's question yesterday. Where do we get the numbers from? I don't think we should fool ourselves. We have no scientific basis for any numbers. And when we, in our book, say 20 to 30%, that number is taken from such vague parallels as what were equity requirements before World War I, i.e. before the government got in, or what is it that banks require when they lend to hedge funds or similar institutions. But none of what we have is really based on science.
Okay.
So, maybe very naive, and but given that, so I understand the difference between micro and macroprudential is the presence of externalities. If you are taking very large position, then something goes wrong, then other people may. So, So there are other systems in economics where externalities have been dealt with taxes or trading permits and things like this. So isn't this something, I mean, one paradigm one should think about? I mean, say, going from finance, where you think that the market will solve all the problems, to something like economics and game theory, where you're thinking about public goods like systemic stability and use this type of instrument?
But the terms are empty. In the case of Macroprudential, we know what it is because it's been done for a long time, and the Macroprudential supervisors have ownership of the term, and that defines it. With respect to anything else, we need to have an impact on what we do with that. I was referring yesterday, well, also here, to the problem of should we use macroprudential supervision as a tool for stimulating the economy. If you ask the Bank of Italy, I've heard representatives of the Bank of Italy on several occasions saying, in the euro area we have a common monetary policy, and that means we cannot use monetary policy to stimulate the national economy, so we need a decentralized macroprudential policy to stimulate the economy. And to some extent you might say that something like targeted long-term refinancing options are about that. This is not exactly what Andrew Crockett thought about when he advertised the term macroprudential in 2000. The term is something of like a toy or a tool in political debate, and it can be used and abused. It's up to us to make a contribution to it not being abused, but to our having a clear sense of what needs to be done. And my position in that respect is I do want to protect the financial system from the macroeconomy and make sure that financial stability is to some extent improved relative to what we get when we just do micro.
Okay, maybe one more question. Okay.
So when we talk about risk, we often think about institutions and regulators, regulations, and we write rules, we have committees.
Sorry?
We write rules, we write regulation, we have committees, and at the end of the day, it's real people who write the rules, and it's real people who have to comply with the rules. So are we running the risk to write lists where we just tick boxes to concrete questions rather than solving the actual problem? And should we perhaps introduce, again, a stronger concept of responsibility and accountability?
Who's we?
We who think about what macroprudential regulation should be.
In an ideal world, I, as a philosopher king, all competent, might be able to design something like that. In practice, we need to realize that any rule that's too complicated is going to be manipulated. And that the complications are to some extent designed to be manipulated. if you ask yourself, how did the Basel system develop? It was, to a large extent, what I would call regulatory capture by sophistication. The industry, when the first proposal for market risk came out in '93, the industry said, "This is ridiculous. We're much better at managing risks. Let us help you." And if you ask, why are sovereign exposures exempt? Well, banks are where the money is. As stated by a bank robber when a journalist asked him why he robbed banks. This is why the German public banks owners, namely the various local and regional governments, are adamant that they don't want to have stricter equity requirements.
Okay, so thanks a lot once again for a very stimulating